Welcome to the Moving Markets podcast on Tuesday, the 13th of January, with me, Bernadette and Anderko. Financial markets have undergone a seismic shift in the last 20-odd years. Historically dominated by institutional investors, we're now seeing the rise of retail traders, so individual investors managing their own capital, trading through digital platforms, and obviously shaping market trends. And here to talk to me about some of the latest developments in the future of finance today is Manuel Villegas from our Next Generation research team. But before that, we're going to catch up on all of the latest markets news with the head of product and investment content, Roman Canziani. Good morning to you, Roman.
Good morning, Bernadette.
Roman, yesterday brought a fascinating mix of factors, geopolitical tension, domestic US political drama, and some interesting corporate news. So why don't we start with the bigger picture? We saw quite a bit of volatility stemming from the US yesterday, specifically concerning the Federal Reserve. Can you elaborate on what transpired?
Well, yes, the core issue revolves around increasing political risk surrounding the Fed. Reports emerged suggesting the administration is considering legal action against Chair Powell. This sparked serious concerns about central bank independence. Well, once again, and when investors worry about political interference in monetary policy, they tend to flock to safer assets. We observed exactly that, a surge in gold prices, strengthening of the Swiss franc, a selective buying in equities perceived as defensive. Essentially, it's a classic flight to safety scenario.
All right, then. So talking about equity markets, despite all the turbulence, European markets managed to close at a record high again. And also US markets ultimately ended higher after a weak start. They were boosted by tech companies and Walmart. So perhaps you could tell us a bit more about that.
Well, yes, overall stocks closed slightly higher in the US, with the S&P 500 up 0.16% and the Nasdaq up about 0.25%. One standout performer was Walmart, whose stock jumped more than 3%. On the flip side, US bank stocks fell sharply after President Donald Trump proposed capping credit card interest rates at 10% for a year. Capital One plunged 6.4%, JP Morgan dropped 1.55%, and other major issuers like Citigroup and American Express also declined. Current card rates hover above 20%, and analysts warn that the cap could erase most card earnings, forcing banks to restrict lending.
Okay, but the generally positive momentum carried over into Asia overnight, particularly in Japan, which is open again.
Yes, precisely. The rally extended eastward with the Asian markets showing considerable strength. Japan in particular stood out. The Nikkei 225 is up more than 3% and government bond yields surged on speculation that Prime Minister Takaichi might call a snap election. This triggered what's being called the Takaichi trade, gains in defense and nuclear stocks alongside a weakening yen. Investors are betting on increased fiscal spending and potentially faster inflation if she wins. The yen fell to levels not seen since July 2024.
Yeah, significant move in the yen there. But looking ahead, Roman, what's dominating the agenda for today?
Yes, today is packed with data points. So we have the US CPI numbers coming out, which are expected to show some continued inflationary pressures. Alongside that, we'll get new home sales data and the federal budget figures. Crucially, it's also the start of the US earnings season, with JP Morgan Chase kicking things off. Investors will be keenly listening to Jamie Dimon's commentary on the state of the US economy.
And beyond the data, are there any other geopolitical factors we need to keep an eye on?
Definitely. President Trump's announcement of a 25% tariff on goods from countries doing business with Iran is a significant development. This could disrupt global trade patterns, particularly affecting nations like China, India, and Turkey. It adds another layer of uncertainty to an already complex geopolitical landscape.
Okay, let's talk about commodities. Gold really stole the show again, hitting record highs yesterday. What's driving this relentless ascent?
But gold is benefiting immensely from the current environment. Geopolitical instability, coupled with the concerns about the Fed's independence, creates a perfect storm for safe haven demand. Lowering expectations for interest rates also make gold more attractive, as it doesn't offer a yield itself. So when rates fall, the opportunity cost of holding gold diminishes. Plus, signs of a cooling US labor market add another layer of support. Overnight, however, gold is a bit weaker, trading now again below $4,600 per ounce.
Okay, and we can't go without touching upon oil. How did that market react to this rise in geopolitical tensions?
Yes, oil prices held firm, but didn't experience massive gains. Worries about potential declines in Iranian exports offered some support, but expectations of increased supply from Venezuela acted as a counterweight. Ongoing concerns about disruptions in Russian supply also remain a factor. This morning, oil is trading up, however, with Brent changing hand around $64 per barrel. And that's it from me today.
Super. Thanks very much for the news update this morning, Roman.
Thank you very much for having me, Bernadette.
And now it's time to talk with Manuel. Good morning to you.
Good morning, Bernadette.
So I mentioned it earlier, the future of finance. Retail traders are starting to dominate US option volumes. So what does that tell us about the new investing landscape?
It is one of the signals that we have to say that we see a structural shift. So retail flows into, for example, zero-day option contracts have exploded in 2025, and they've turned volatility into a wealth-building tool for a generation that has been largely priced out of housing. And this isn't a fad, but it is a reorganization of household balance sheets in the US and in the rest of the world to a lesser extent.
Okay, you mentioned housing there. Why are younger generations shifting away from housing as a wealth building tool?
I mean, housing affordability has been gradually collapsing due to rate lock-ins, supply constraints, and institutional ownership, so much so that it has become quite the political tool in the US. We have millennials and the Generation Z, which have been priced out. So capital that would have gone into mortgages is now flowing into liquid, high-velocity assets like equities, options, and digital assets, for example, with some mechanisms like prediction markets being the most novel feat that some venture capital companies are able to offer in the US and in the rest of the world.
So what's driving the surge then in short-dated options and prediction markets?
So it is financial nihilism. It is a rejection for what has been happening due to the reasons that we outlined before. For many, the slow compounding returns through traditional saving feels inadequate, especially with the inflation backdrop that we've had over the past few years. Zero-day options, event contracts, they do offer rapid leverage returns, and volatility is not seen as a risk so much, but as the only ladder for social mobility. On prediction markets, what we see is that they have become to some the ultimate liquid asset. You have binary outcomes, there's high velocity, and it can be uncorrelated to traditional financial markets. If real estate is a 30-year bet, these are 30-minute bets. And before, Roman was mentioning Venezuela. So we have seen how prediction markets have priced in the possibilities for everything happening all the way up from geopolitics to an economic recovery in the country. And there's two main platforms. We have Robinhood and we have Kalshi, and they have turned these event contracts into a mainstream product. It is a multi-billion-dollar asset class as of now, and we see information advantages being monetizable in real time. In 2025, we saw the year of the event contract. We saw retail flows exploding, and we saw Robinhood and other retail brokerages, prediction market revenues jumped over tenfold in the year.
Okay, then. So how are these retail platforms reshaping market structure then, Manuel?
So there's just a collapse in the entry barriers. There is commission-free trading in some of these platforms, in most of them actually, and fractional ownership. It's not only in the US, but we also have many examples in Europe and in Asia. So it really has democratized access for a retail trader into financial markets. Make no mistake that 20 years ago, you couldn't really access the fixed income market, for example, if you didn't have a certain amount of capital. Normally, you needed 6 digits. And these platforms now function as brokerages, banks, and retirement planners, integrating options, prediction markets, advisory tools. And what we have to say is that this is a structural shift. It's not a cyclical trend, and we don't think this is going to change anytime soon. If anything, it's only going to continue opening up more and more as time goes by. And that's it from my end, Bernadette. Back to you.
Great. Thanks very much. Interesting topic. I'm sure we'll be talking a lot more about it in the future, Manuel. Thanks for joining us today. Well, that concludes today's podcast. Thank you very much to my guest today, and thank you all for listening. Please do tune in again tomorrow when we'll be back with more of our experts to discuss what's moving markets. So don't miss that. Meanwhile, good luck today and goodbye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.